Okay, good evening, ladies and gentlemen. This is Clueless 8, and let me go over a whole bunch of charts here. So listen carefully. I'll try to make it as simple as possible, which I always try to do. Use the KISS principle, keep it simple, stupid, and it works out pretty good. So here we are. This is a quick snapshot of the Dow Jones Industrial Average from the lows of February 2014 to where we are today. This was the lows of last October. And this was the huge, humongous move that we saw. And I'll be honest with you, I did not expect this move that we had from August 24th, and then the higher low of September 29th to equal this move. But we did that. Notice the pattern symmetry. It just blows my mind. Let me just get that nice thick. Where it is? Where is that drawing tool? I don't see it. That's great. Right when I need it. Bear with me 1 second. So I guess the drawing tool, they just won't give it to me today. So I'm just going to use, I'm just going to show it to you. So if you look at the pattern symmetry of this move between October and December, right? December 5th. And look at this move here. I mean, the pattern symmetry is just way too similar. It's unbelievable. Now, this was the heavy duty volatility phase till about 929. So this move right here between 929 September 29th and a month later, ending in October, right before Halloween, was exactly this. See the similarity? Almost there. All right. So the bottom line is when I talk about pattern symmetry, I mean it because human behavior never changes. Every crisis happens for the same, every crisis is the same. The reactions are the same for different reasons. Okay. Because human behavior pretty much is the same. It's fight or flight. Whichever the case, this move here, this fast and furious, was pretty much what we got here. Did take me by surprise. We managed to catch a lot of heavy duty movers. But like I said, the market never ceases to amaze me. So keep on learning, be an eternal student of the financial markets and your own behavior in responding to them, and you shall become a very effective trader. That's what it is. I'm still learning. I'm still learning every single day. But what I see in the similarity and the pattern symmetry is just unbelievable. So if you really think about it, when we started to see the market move out of here, um, it just seems like if we were robots, we would have just put down all our monies down here and said, okay, a month later, this is what would be the case. And these lines were all drawn before, so it wasn't like some sort of magic. It did get there. So let me just show you. So here was the large channel that I'd drawn. So I'm going to take this line out here for a second. This is the downtrend channel, right? So guess what happened? We hit the downtrend channel and we pulled back a bit. We pulled back a bit. Now keep in mind that the standard deviation at this point is pretty high away from the moving averages, 34 and the 50. We went to the upper end of the Bollinger, which actually is 17,884 to be honest with you. And don't be surprised if we get there. Um, and a full pattern symmetry. I wish I could get that big line that I can't seem to find it where it is, that big crayon that I use. Okay. The pattern symmetry would say that we complete the full cycle possibly up here at around 18,132. One way or the other, my opinion is the market wants to go to 18,000. All right? And that's just one of those psychological things that happens, and it happens. So the thing is that at this point, we are overbought, but look what's happening on the stochastics. The stochastics are moving sideways. I've mentioned this before, so keep on watching this. If you see a sharp dip, that's fine. A sharp dip, a quick contraction to alleviate the overbought conditions is all good. What we don't want is the stochastics to come down here and keep on rolling down at the bottom end. That means there's something going wrong, terribly going wrong. Okay, so I'm going to be watching this very carefully. In the meantime, this is sharply rising, so this needs to rise and reduce the gap or the standard deviation from where the indices are right now. So don't be surprised if we get a quick pullback into the 70, like a 200-300 type of pullback, which I think is almost mandatory at this point. I do notice a small gap here. That gap's around 17,500. So a quick drop about 160 points or so would be welcome, to be honest with you. So the point is that so that's it. That's for the Dow Jones. Now, in the meantime, if we see a complete breakdown and we break below the 17,000 level again, then it doesn't look good, because 17,000 is not just a psychological number. That was a major support level here back on September, when Santa Claus miraculously appeared in the middle of September. Remember, they kept on talking about that Santa's disappeared, no one's going to come. Well, Santa came in with a vengeance and slaughtered the dogmatic bears. So the same thing here. And then we retested the same levels in February 15th. And so this is an important level to keep in mind. Okay, so around the 17,000 level. If we break that, then something is not going well, and that could, and I know nobody can imagine that could presage a move down to test the lows of 16,000, if not 15,300. That's only if we have a rapid break of 17,000, and of course I'll be watching for all kinds of different internals to tell me whether or not that's the case. Anyway, that's an outlier scenario, but it is very possible. Remember one thing about trading and about money making. If you tune your mind and your mental strength, brains, towards reviewing and what do you call towards assessing all the probabilities and all the different scenarios, and that's what game theory is all about, then you are not shocked by anything. It doesn't mean that it's not going to hit you like a sucker punch if you have a long position and then things are not going right that day. But believe me when I tell you that you'll be so well prepared that that minor hit can very easily be made up. It happens all the time for people who work with me and trade with us. Okay, and the winners are far bigger than the losers, and you can certainly go ahead and get ahead far better than anyone else. You don't need to have your P&L in the green every single day. Believe me when I tell you. Yeah, it feels great, but you know what? That's an amateur game. You should look at your P&L on a weekly basis and see where you stand, and that's it. That's really what matters. If you're a trader, as an investor, or no trader investor type of thing, swing trader, you want to look at it on a monthly basis. I know it seems crazy, but that's just the way it is. If you look at your P&L every single day to see if it's red or green, I can assure you, you will never catch the big trades. Never. And I've shown this over and over again. So for a lot of new members who are listening to me, listen carefully. If you think you're going to make money and your P&L, your profit and loss statement at the end of the day is always going to be green, then you are plain stupid. Honestly, I'm just telling you that you know that. That's amateur stupid stuff. What you need to look at is on a weekly basis where you stand. And that's really what matters. And in this type of markets, we play the volatility cards, we buy ugly lows, we sell highs, and vice versa. So on a certain day when you're buying ugly lows, don't expect your P&L to be green. Simple stuff, right? But it helps. So let's take a quick look at the NASDAQ. So again, everything is, I'm showing you dailies all the way through. So nothing really wrong in the technical picture. The overhead resistances are there, and I think we'll still get there, depending on what happens. In the meantime, these are the support levels here that I'm looking at, that I had drawn weeks ago. Now, what's interesting about the NASDAQ is that we haven't had the 50 and the 34 crossover yet. And if I'm right, this is a daily. We had a crossover, right? Look at that. So, and that's primarily because of oil too. Just keep that in mind. So, oops, sorry. We're going to move to that in a second. So on the NASDAQ, we still have some catch up to do. All right? Not catch up, catch up. All right? So it's good. I like that. And I like things which are not runaway trains. I like things when nobody really wants it. Well, that's not true. When I say nobody, that's actually a stupid statement. When nobody wants it, I mean there are millions of traders. I mean millions of algos and traders operating in the market. So when I say it's not like the old days, but I go with the majority consensus. That's what I mean by saying when no one wants it. So anyway, the bottom line is that on this one, a pullback down to the 49.9 level, cracking 590, 5,000 on the NASDAQ and going below a little bit, testing these levels, completely fine. Moving sideways, A-OK. I'm going to stick to dailies here. This one I like a lot. This is the Russell 2000. I think it's got the most catch up to do. And at this point, this geometric chart you're looking at has served very well for us. It's made some significant amounts of money. Russell calls have, I don't even go there. They have gone from what? From like $8 to about 34 in like 24 hours, right? I don't need to remind everyone, and it's happened few times. So this one, based on oil, commodities, and biotechs are a good portion of the Russell 2000, has room to move. It's got room to move into the 1200s. 40 points on the Russell, you're looking about 150% return on your money, if not more. And you know what? That's not small chump change. You buy a couple of those RUT calls, at in the single digits, and then they get up into the high double digits, into the 20s, into the 30s. It feels great. You know it. Okay. If you've been there, you know it. If you haven't been there, test it out if you're an active trader. Remember, these are risk trades, but they're all mathematical correlations with what's going on, and that's my job. I'm showing you what I see. So the Russell 2000 I like a lot here. Based on the formation, and again a retest of this. Notice one thing here: the 34 is just about to cross the 50. We need the 50 to turn. This is the daily chart, so I think this has the most potential in my opinion. And I said that the other day. I caught the bottom before it ran up, right? And we did unbelievable on the oil trades on the USOs, which were around 1,000% plus, and of course the Russell 2002 couple of 100% plus. IWM same story, nothing to see here. S&P 500, this chart is I got 4 minutes. This chart is the same chart as this one, easier to see on this one. Like I said on my Periscope broadcast and my other video cast, I'll put the static chart of this out there, and it's been out there for a while now. Here, your 50 and the 34s. We don't want these lines to really curl down too much. This is a 1-hour traders chart, and bottom line is that we don't want this to honestly to break below 202. That's around 2020 or so, like I showed on the other side. Because once you do that, then you actually have a trend change. So as long it can come down here, it can come down to 204.37. Might look really ugly, but it's not a trend change. A trend change is basically below the 202 level. That means it's going to it's going to go to 1980s. Like I said, we do not want to go into the 1900s. This is the line in the sand, 198.75. Breaks that, see you later. Okay? And in the meantime, I'm not going to be sitting around like a dimwit as this moves down below these levels. I'm going to be doing tactical shorts, and I'm looking forward to making money off that. Okay, let's take a look at the VIX and the RVX. I'm running out of time, 3 minutes to go. This is the chart, hourly chart of the VIX. As you can see, you're starting to see signs of a turn, but look at the Bollinger caps. 16 is in the top, low is 13, and this is really what I'm playing off. All right, let's take a look at the RVX. That's for the Russell 2000. Same thing here. It's capped between the Bollingers here, right? And the acceleration bands up here. So anybody looking at this chart thinking it's going to go all the way up here, well, they have to follow what the charts are telling us, and they're telling us that this is the trading band it's trading in. Once it breaks above that, let's say it breaks above 20, then there's a massive trend change. UVXY. We've been playing this on and off. Very fast moving, as you know, it's correlated with the VIX, and bottom line is that at this point, if I zone in, you can see it's starting to move up. The downtrend line is intersected at around 33. My feeling is when we do get that 160 to 200 point pullback, we could possibly get that this coming week, or after the first 5 trading days of the month. Remember my old theory that's when institutionals and the pension funds put new money into the market, so there's somewhat of an upside bias. So after the first 5 trading days, 5 to 6 trading days, not calendar days, trading days of November, we are in for a correction. So again, we break out of this level at 32, then we could even be looking at 42. So again, I think the VIX is a great hedge. On the lower end, 25 is it, and I think the risk reward tells me that we can get 4, 5, 6 points out of this. And buying the common is the best. And of course, you can play the options on it too. So that encompasses. Oh, there's your USO. I just have a few seconds. That is a fantastic looking chart on the hourly. And honestly speaking, this looks like it does want to go to 1625. All right, oil's on the move up, and that's it. Give you a nice encompassing view. I'll put some other statistical data on the end of the week report. engage with you guys tomorrow, ladies and gentlemen.